from the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday the 8th of October, 3:05 in London, 10:05 in New York, 25 minutes into the trading day in the United States, 35 minutes even, I'll get the maths right. From London, I'm Guy Johnson with my co-host in New York, Alix Steel. Alex, let's talk about the market reaction to what we're seeing to this payroll number. The payroll number was a disappointment. Markets are drifting sideways, at least on equities. I think everybody's trying to figure out whether or not this is a decent number in Jay Powell's book. Is it enough?
Well, it seemed like from what Powell said at the last presser is that the bar's really low for them not to kind of lay out any kind of taper timeline. But you take a look at the individual, what we're seeing in the markets, it's wishy-washy, like you just said. The S&P just up by 0.2%. Energy and financials leading the way. We've seen that as we rotate into those cyclical value names. Obviously, energy helped yet again by Brent, up almost 2 percentage points. There is a fire at a natural gas plant in Siberia, which is going to have problems getting gas maybe to China, which then can disrupt the whole market. But we'll talk about that over the next couple hours. What I did want to point out is the 10-year yield. We're now up 2 basis points, 1.6. The convexity trading, that's what we're going to wind up hearing a lot today. You're getting at the point where you might have to sell some of those mortgages because the refi market's going to trail off at 1.6, and that could sort of lead to more steepening of the curve. But I also wonder, Guy, how much of that is all about what's happening in the UK? Front-end yields here very anchored. Back-end yields not, but I wonder if we're just following UK yields higher because they're just shooting up right now.
Absolutely. There's plenty to drive the inflationary narrative here in the UK, and certainly the governor of the Bank of England has been talking about that, and his new chief economist has been talking now about that. But the payroll figure is front and center today. It says on the screen in front of me that it was a dismal number. Was it really a dismal number? What we know about the US economy at the moment is there is a huge amount of demand for jobs. Why isn't the supply side of the labour market filling those jobs in? Many questions need to be asked. There's a seasonality factor that is overlaying all of this as well. Bloomberg's international economics and policy correspondent, Mike McKee, has had a little while now to dig into the details to form a picture. What is that picture? And what do you think the Fed thinks about the data that it now has?
Well, I've been digging into this for quite some time now, Guy, and I have to tell you, I have no idea. Where have all the workers gone? Why are they not coming back to work? That's a question the Fed's going to be asking. Yeah. Is it the Delta variant? Are they going to come back this month? We won't know when the Fed next meets. As you mentioned earlier, 194,000 jobs created. The headline, definitely a disappointment. We did see a big revision up to the August and July numbers, so we are seeing more people at work than the headline would have you figure, but it's still not what people were expecting. On the other hand, this was not what people were expecting. A drop to 4.8% in the unemployment rate. That largely has to do with the fact that all those workers disappeared. The labor force shrank during the month. Unusual, especially since the long-term benefits ended early in the month. You'd think some of those people would be out looking for work. Even if they didn't find jobs yet, they'd be out looking for work. Got this one backwards, flip these two numbers. 61.6 is the participation rate for the month of September. And the problem there is it needs to go up, not down. It was forecast to go up, not down. And we did see a 4.6% rise in average hourly earnings, which is largely compositional, it appears, because the number of people who got low-quality jobs, low-paid jobs, was very small this month compared to others. Here's the question that we are asking, and I just mentioned it a moment ago, where have all the workers gone? Well, here's the latest changes. We'll go through this first. State and local education, 160,000 jobs lost. Now, that's because the Labor Department says not as many teachers were hired, not as many employees in education, but they go on to say it's a seasonal adjustment problem because of last year when nobody was at work in the schools. There were actually 1 million people who were hired during the month or who came back to work onto school payrolls, and it shows up as a seasonal decline. Automobiles and parts, we've seen people, because they can't get the proper the chips for cars. We've seen factories close down, so they lost some jobs. Airlines coming back, though, as tourism has picked up and airlines are trying to restaff. Healthcare lost 17,500 jobs. That's unusual given the situation, except that maybe vaccine and mask mandates cause people to leave. This is the chart I was looking for before. I want to show you help wanted. This is the participation rate that we were talking about earlier that declined. This is the employment to population ratio. So this keeps going up, but the participation rate goes down because a lot of these people aren't looking for work right now. And why is that? That's the question everybody is asking today.
Mike, really great stuff. You ask where all the workers have gone. I ask where all the women have gone, because a lot of them have also left the workforce, which is definitely not a good sign. Mike McKee, thanks a lot. So that's a look at the jobs number. What does it mean for the Fed, and what does it mean for the rate market? Ira Jersey, our senior rate strategist for Bloomberg Intelligence, joins us now. Ira, 1-6. Say the word convexity.
Yeah, so there might be a little bit of a convexity pocket here, and I apologize for my dog in the background. She obviously was not happy with the payrolls report either. But at the end of the day, I think we're hitting some pretty important technical levels. So regardless of if we do have some mortgage selling or additional mortgage hedging, which will show up in the options market before it shows up in the rate market, and we haven't seen any big buying of puts on yields yet. So until we start to see that, I suspect that we'll kind of meander here under 1.7%. But 1.71%, that's the next key number to look at, because we just broke above a pretty important near-term technical level.
Yeah, oil's moving higher as well. We're keeping an eye on that. You got TI north of 80. You want to be paying attention to what is happening in the energy story. We certainly are over here in Europe. Ira, thank you very much indeed. Ira Jersey of Bloomberg Intelligence, and what's happening in the rates market. It's a really tough call right now. Somebody writing in saying it really depends on how the Fed plays it, if they're late, if they're on time, in terms of the way that the reaction from the Fed comes through. Let's take a look, Alex, at how equities are playing all of this. Equities just drifting sideways. I'm trying to figure out exactly what this all means. Abigail Doolittle dealing with the details.
Sideways indeed, Guy. You could even make the case this is much ado about nothing, or even that Goldilocks scenario, because you do, after all, have the S&P 500 slightly higher, up about 0.1%, better than a decline. Markets may be telling us that even though this is a headline miss, the report itself is solid for markets, because it doesn't mean that there's going to be a full-on taper. So you, again, have the S&P 500 ever so slightly up on the week as well. And if we broaden it out cross asset class and take a look at what you and Alex were taking a look at before, the picture overall is really sort of just sideways. Not a lot of big moves really anywhere rocking the boat, although the 10-year yield at this point now starting to climb back higher, which is interesting because it does tell you that market participants, traders, think that the Fed will be on pace for a taper, but some are calling it a dovish taper. So it's okay for stocks, okay for bonds in terms of rates going higher. The Bloomberg dollar index basically flat. Crude getting a solid bid, up 2% at this point, almost close to that important $80 per barrel level, its highest level since 2014. That is certainly risk on and a strong indication of the economy. And then gold up 0.4%. The big debate on the year, though, Alex, is it value or is it growth? Well, it turns out on the year, it's both. If we take a look at a year-to-date chart of the value index and the growth index, we are going to see that they're basically, despite the fact that we've had huge gaps where value is outperforming or huge gaps where growth is outperforming, right now, they're both up. It's a Goldilocks year for these two styles, sort of putting the debate to, I don't want to say an end, but it suggests that managers at this point, Alex, favoring both growth and value.
Yeah, that's a Tina. That's a Tina trade. There is no alternative trade. Abigail, thanks a lot. Really appreciate it. Abigail Doolittle joining us from Bloomberg. Moments ago, U.S. Secretary of Labor Marty Walsh shared his insights into these jobs numbers.
It's about the pandemic, and this is not just an American issue. This is a worldwide issue with participation rate in the workforce. You know, we clearly have more work to do. People are concerned about the Delta variant. People are concerned about their health, and I think, quite honestly, a lot of people are reevaluating their work-life balance and changing careers.
Well, joining us now is Elise Gould, Economic Policy Institute senior economist. Elise, it's great to get your perspective today. And I want to start where John started with Marty Walsh, was the labor force participation rate. What gets that up?
Well, I think the truth is, as he stated, is that we are still in the middle of a pandemic, right? So we saw a five-fold increase in caseloads between July and August. That explained a lot of that slowdown that we saw in August that many people didn't expect. I think the pandemic is playing a much larger role there. And then we saw it continue to rise through the end of August into early September. And the rate for the reference week for September that we're looking at in today's jobs report was about the same in terms of caseloads as it was in August. So we're not seeing much improvement there. So people are concerned, and rightly so, concerned about their health and maybe not coming back in yet.
Elise, I want to ask the question that Alex asked at the top of the show. Where are all the women gone? The labour force has seen women leaving in significantly higher numbers than men during this pandemic. They're not coming back at the moment. Do we need to see a more stable school story before that happens?
I think that's definitely part of the picture here. So we saw many students go back to in-person schooling for the first time. We saw schools across the country opening for 5-day-a-week in-person, no longer doing the hybrid, no longer doing virtual learning. And so there will be, I would hope, in coming months, if we see that stabilize, it's gone on for a few weeks now, if we see that stabilize, that may be some hope that more women will be able to enter. But remember, that doesn't necessarily speak to any concerns about being able to find childcare for women who have younger children, or maybe still caring for older family members who have gotten sick in the last year.
So what's the impact of that then on the wage picture? Because that's going to be the inflation pass-through, right? So if you wind up having a tentative women coming back into the labor force, we don't really have a clear picture on that. How do we know what wages are going to do?
Well, that's a great question. I think wages is still basically a composition story, which you had just mentioned a few minutes ago. I think that it is still, when we look at wages, economy-wide wages, a lot of wages did go up between 2019 and 2020. Again, that's because the bottom dropped out of the labor market. We may see moving forward the same phenomenon reverse. We may be seeing wage growth actually slowing as more lower wage, lower hour jobs return to labor market. That GDP gap is much smaller than the employment gap because so many of those that were hurt the most, so many low-wage jobs, low-hour jobs are what's missing in today's economy.
Yep. We don't know when these people are going to come back. We don't know what is going on here at the moment. How difficult, therefore, is the job of the Fed? It is trying to figure out where full employment is. I have no clue. Can you help me?
Well, the unemployment rate is one indicator, but as you say, I think the participation rate has to be increased substantially. There are many more people that are hurt in today's economy than are reflected in the official unemployment rate. And that includes Black workers have much higher unemployment rates than white workers, Hispanic workers much higher as well than white workers. We need to be looking across the economy at many different measures before we think about what, to really measure what the recovery is looking like.
So clearly it's really hard to be an economist right now. So I'm wondering, the rhetoric seems to be this isn't enough to throw off a Fed taper. Just look at what's happening with the curve. Do we get different kinds of languages now? Are there going to be more caveats put into some kind of statement that it's introducing tapering?
That's an interesting question. I still think that the pandemic is playing an outsized role here, and we need to be paying attention to that. So as an economist, I do feel like I'm taking the back seat to still what the health experts and the public health experts out there need to be telling us what to do to make sure that people can still remain safe and that we are paying attention to that moving forwards. And I think that that is still our number one concern as people return to work.
Is monetary policy having any effects on the labour market at the moment? Is what the Fed is doing useful right now? The question that they've got to ask is whether or not they should start tapering right now. Ultimately, we're moving towards rate hikes, maybe. But do you think there is still a need for the Fed to continue to support this labour market?
Yes, absolutely. This labor market is still down millions of jobs from where we were in February 2020. If you look at the pre-pandemic growth rates, it's more like an 8 million shortfall, maybe a 6 million shortfall. If you just look at population growth, we are far from a full employment economy. We need to keep moving forward in making this recovery as strong as possible.
If we get a $1.2 trillion infrastructure plan, does that help this scenario in the short term?
Well, I think it will keep on putting pressure in years to come to make sure that we get a stronger economy that works for everyone. So I think it is an important investment. And we talk about women's labor force participation. Many of the investments will help support and bolster women's labor force participation, will help the economy overall.
In terms of kind of how this is breaking down, and we're trying to get an understanding of kind of the various components. We know that jolts are really strong. We know that the labour market has many openings. How many of the people that are not in the labour market at the moment have gone permanently, and how many do you think are still potentially going to come back? Is there any way of figuring that out right now? Because we hear all this talk about the fact that people have retired permanently from the labour market, maybe earlier than they would have originally. How do we know? What can we do to figure out what those numbers in those two buckets look like?
Yeah, it's a great question. It happened in the aftermath of the Great Recession. People thought that there was going to be this structurally higher unemployment. There were going to be lower going forward. We would have lower participation in the labor force. And eventually, as the economy picked up, those people came back. They were not missing forever. They were not playing video games. They were not necessarily retiring. They wanted to come back to the labor force. And I think we will see that here as well. I think as the economy picks up, as some of these jobs become better, one of the things we also saw in the last couple of months was a slowdown in wage growth, particularly when we look at something like leisure and hospitality, where some employers have provided anecdotal evidence of shortages. If you would think that there would be shortages, you should be seeing faster wage growth, not a slowdown in wage growth. Really fascinating conversation, Elise. Thank you very much. Elise Gould of the Economic Policy Institute, thank you very much. And Guy, I don't know about you, but anecdotally, I talk to people from different industries across the board, and people are really thinking about like changing careers, doing different things, doing a hybrid kind of career. Like the pandemic really shifted, I think, different priorities. And I'm talking people that I know who like work in the FBI to work in TV. Like this is like across the board.
That's quite the switch.
I know.
Yeah.
No. I mean, like, I know people in the FBI and not here. I mean, like in TV that are like thinking about career changes, not, I don't know how.
I was thinking about going from the FBI to TV, which would be, unless you're going via some sort of FBI-themed show, quite a big jump, I would have thought. We digress down a crazy rabbit hole. Look, I think what's going on here is that a lot of people are still worried about the virus. I think a lot of people, as you say, are trying to figure out what their choices are. I think a lot of people that had benefits maybe still have some of those benefits. You look at the saving rate, it is still relatively high. That maybe gives people cushion, a little bit more of a cushion to take time to make that decision, Alex. This is maybe not working out as quickly as maybe we thought it would. People all coming back. People are taking their time.
Yeah, and can the Fed actually fix that? I don't know.
Yeah, that's a tough ask for monetary policy, isn't it?
Yeah.
It's time for the Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Quarterly sales at Taiwan's semiconductor manufacturing jumped to a record. That underscores how the world's largest contract chip maker is benefiting from the global shortage of a product that powers everything from cars to smartphones. Third quarter revenue was in line with estimates, and September sales were 20% higher than a year ago. The crypto community has been waiting for years for a U.S. Bitcoin ETF. Now there could be as many as 4 of them in a matter of weeks. This month, the SEC will again review applications for ETFs based on the largest cryptocurrency. This time, they all follow a format that SEC Chair Gary Gensler indicates could be received favorably. And that is your latest business flash. Guy, Alex.
Ritika, thank you very much indeed. Right, it's Friday. It's ETF Friday. Here with the largest weekly outflows, Bloomberg's Dave Wilson.
Thanks, Guy. Yeah, you've got the usual suspect kind of leading the parade, the S&P 500 spiders with the outflows. Beyond that, you see select sector spiders for healthcare and industrial companies at the top of the list, along with 20-plus year Treasury. And, beyond that, I mean, what's interesting is what's happening sort of in terms of, leveraged products, you might say. You have volatility shares coming out with a couple of exchange-traded notes that track velocity shares from Credit Suisse, which they were kind of blew up in the last few years, and one of them only trades over the counter at this point. So, everything old is new again.
Everything old is new again. I feel like there's a reference I can
That makes me feel, can I just say, that makes me feel a lot better.
going to say. I learned today that
Before you get that jibe in.
I already got it in. We did it at the same time. Okay, also, you got to take a look at what's happening in the gasoline, natural gas market as well. I mean, those ETFs are going to go haywire also. Coming up, we'll break down some individual stock names to play out the jobs number, look ahead to earnings with Sarah Hunt. This is Bloomberg. Live from New York, I'm Alix Steel with Guy Johnson over in London. This is Bloomberg Markets. So the S&P looking for direction following that jobs number. Volume also pretty weak. Here are some of the details underlying action in the market. Abigail Doolittle. It has been one crazy week for the likes of energy and financials.
It has been one crazy week, and after that big down Monday, it's been an up week. We have the S&P 500 higher on the week. Relative to energy, that's the best sector on the week, and that has everything to do with oil. Oil touching above $80 a barrel for the first time since 2014, up for a 7th week in a row. Yields, though, also up for a 7th week in a row. We've had bonds now selling off for 7 weeks in a row, helping the financials be the second best sector, up 2.2%. Making that interesting, utilities also one of the top sectors, up 1.7%. That's interesting only because you don't typically have both financials and utilities climbing at the same time. Those higher yields make utility dividends look less attractive. It's a defensive sector, so that's something to keep in mind. Some investors going for defense, and then take a look at the industrials. That's very solid, up 1.6%. Now, of course, the big question, or one of the big questions on the year, beyond the growth value question, big cap or small cap? Well, similar to growth and value, even though there have been some big divergences on the year, at this point, we have pretty solid gains for both big cap, the S&P 500 up about 17% on the year, small cap, that Russell 2000, despite the recent weakness, that range all year, up about 14%. So lots of solid gains for both large cap and small cap stocks. And there is reason to think, Guy, that maybe stocks are going to rebound a little bit from the recent volatility. What we're looking at here is a very busy chart, but what we're looking at really in white is the put call volume on the S&P 500. In blue, the 5-day moving average on the S&P 500. So really normalizing everything out. And you can see that put call has been coming down, that volume, telling you that less people are hedging or buying bearish puts on the S&P 500 than had been the case. This is the S&P 500 5-day moving averages moving up, suggesting that maybe there's going to be some more upside ahead, Guy.
Yeah, one of the reasons they may not be buying puts so much is they are flipping expensive. You just take a look at what is happening in terms of pricing, trying to hedge the downside. It's a tough ask at the moment, and you do wonder whether or not that pricing story is just kind of keeping people out of the market in terms of kind of where they would like to be. They're a bit worried. They'd like to buy some puts. There are other ways of doing it. We were talking to Manish Deshpande a little bit earlier on this week, Alex, about this. Let's talk about oil. I can't believe that you haven't spent more time talking about this today. What is it, 2014? We haven't been this high? Oil's at 80. TI's at 80.
Yeah. So Brent hit that level earlier in the week. Now we have WTI up there. What I find so interesting, though, is the market signal on that is for producers to go and pump more oil. I really don't think they're going to do that, at least not the public players.
Until when? Until when? At what point? At some point, shareholders are going to go, there is a massive opportunity here, particularly if you can turn this stuff around quickly. We're not talking about large investments. If you can put a few extra rigs to work, if you can get the labor, if you can get the rigs, isn't there a massive opportunity?
A few things. One, maybe the private guys will do that. But two, labor's still an issue. Wages are going to get a lot higher. Input costs are also rising. So from that angle, it's going to hurt a little bit. And until shareholders want them to, they're not going to do it. I mean, maybe on the margin or incrementally, but I just can't see someone coming in and saying, like, we're going to add a lot more rigs because of this, because shareholders will sell, but certain shareholders will not like it.
No, what I find interesting, though, at the moment is that this potentially is an under-owned area because a lot of people with their ESG mandates can't put as much money to work here. Hedge funds potentially can. So it's interesting to see who ultimately is making hay on this story. Maybe it is the hedge fund community. Maybe sort of wider shareholders are not going to pick up some of the benefit. Obviously, they're going to see the fact that shares are going higher. They'll see that driven up. But it's going to be interesting to see ultimately whether or not actually this discipline sticks. Let's talk broadly about what else is going on here. Sarah Hunt, Alpine Woods portfolio manager. I'm sure she's got a few things to say about the energy sector. But let's start with the broader picture, the payroll numbers, Sarah. We're trying to figure out what we want to do in this market. We've got a Fed, and a lot of things feel macro-driven at the moment, that is looking at data in the States that is not delivering quite what they would have thought, and as a result of which this taper is in question. As an equity investor, what do you do with that?
Well, I mean, we've talked about this before, but it's very clear that the Fed is trying to separate out the taper from any tightening cycle. And I think you could argue with where you see some of the inflation numbers and some of the other underlying things that are going on in the economy. But the taper is probably something that they will go forward with at some point. It might be November, it might be December. I think it's probably likely to stay where they've signaled in November, because you don't need them to be doing that so much right now. I think the question on the labor market has a lot to do with, you've got a combination of the Delta variant, you had those big storms that went through, and that can affect some of the numbers. You've got some very strange seasonal adjustments because of what happened last year. So I think that there's a lot up in the air, and they're not going to have the data for October by November. But I think that the economy is not in such bad shape that it doesn't seem like getting rid of some of those emergency COVID measures at this point is probably not a bad idea. So I think that is not, they are being very careful, though, to make sure that they don't think that they're not trying to signal that that's going to start a tightening cycle.
Right. So, Sarah, that leads me to the yield curve, because that part of it, separating the taper from the hike, is really cementing and anchoring that front end while that back end really rises. So you're seeing that bear steepening. And I'm wondering how much more juice you think is left in the financial trade.
Well, I think the financials have been under pressure for quite a long time. So I think that there is still some room in the financial trade. And I think that, a lot of those companies have done a very good job in the interim of living off of different things besides net interest margin. So you've seen a lot of different fee structures. You've seen a lot going on while we've been living in a world of zero interest rates. So the fact that you might get a little bit more room for them on the interest rate curve, I think is actually a benefit to them. And I think that the underlying things that they've done before that happened are actually going to continue. So I think the financials do have some space here.
Financials up, tech down. Is that the narrative, or is it a little bit more nuanced?
Well, I think the tech down narrative with higher interest rates is one that affects, I think, more the big mega caps than anything else. And even that, I tend to question whether or not that's really, that correlation really should exist, because you still do have growth across even the mega cap tech stocks. But I think the underlying tech situation is not going to get worse. I mean, you were just talking about semiconductors and how much they feed into basically everything that we do. The cycles on that are very different than they used to be, and the cycles on technology are very different than they used to be. They used to be driven by individual components like laptops or cell phones, and now you've got everything with semiconductor content in it. So I don't think that the tech sector is one that is going to be as negatively affected by interest rates as people are concerned. But I would believe that there's a knee-jerk reaction as rates go higher for people to stay away from that sector. So I do think that there is some trade-off there, but I don't know that longer term it really exists in that same way.
Sorry for that noise. I literally dropped all my beverages in that moment. Sarah, let's circle back then to the other part of the value trade, which is energy. We were just talking about that. So you're looking at the best week here since January of 2020 for the energy sector space. For so long, it felt like the energy stocks weren't keeping up with the actual oil price, and now they are. Do you want to be a buyer of energy stocks right now? And I guess, why?
Well, I mean, you were just talking about the fact that a lot of people have an ESG mandate that wants them to stay away from oil. And I think, we've heard from our clients for the first time in the last year or two, that is something that they are more interested in. Now, we have places where we can put energy, where it's not, we've got some hedge funds that we can put energy into. And I think that energy does have some legs here, because you've seen a couple of years of underinvestment. And to the discussion you were having just prior to my joining, the question about whether or not banks are going to fund or shareholders want to fund development, at least in the U.S. and in parts of Europe, for companies to go ahead and make those exploration commitments is a really big question. And there is some short-term movements that you can have on the side of, you could put some more land rigs to work, you can do some other things, but the larger offshore stuff, there's been very little investment on that side. And then the joke in the oil industry is that low prices solve the problem of low prices, because low prices enough, you don't get a lot of investment. So there's going to be some questions there. The move towards a more ESG friendly energy development world, it can't go as fast as people would like it to go. So you still are going to have those underlying, you're going to have the underlying need for the hydrocarbons that people are trying to replace. And I think that there's been a little bit of a disconnect on the timing. And so there's been underinvestment on the side of normal sort of fossil fuels, because people are expecting there to be a quick catch up from other sources. And I think right now that's really sort of in question, at least in terms of the timing, not ultimately the goal.
Sarah, so we've got underinvestment in energy, potentially leading to higher prices. We've got potentially underinvestment in other materials areas as well. It's interesting to see iron ore popping back up as much as it has off its recent lows. If we're heading to into an inflationary environment, if we are going to see inflation picking up, maybe remaining a little bit more sticky, the labour market can't sort itself out, we've got supply shortages across the supply chains, as you've just been referencing, we've got higher potential raw material costs going into all of that as well. How do you want to position in that inflationary environment? Where do you want to be? You talked about financials, but just go a little bit more broadly. How do I want to position my portfolio if I think inflation is going to be with us for a while?
So I think that, to the extent that people who are at the latter part of the chain on the industrial side have a harder time pushing on prices, that sometimes the earlier inputs, like right now, the energy inputs those prices can be higher. So I think that there is some opportunity in the energy space. I think there's also some possibilities in the material space. The real question is what's going to happen with the economy, right? So to the extent that we were talking about technology stocks before, a lot of those stocks are now the chains that become more interesting because there is an ability to push price. And I think that as we start to see, you're already seeing problems in the food industry. You're seeing some strikes in the food industry. There's some underlying issues that are difficult to parse out. So I think defense stocks don't look particularly expensive here right now. And I think that you've got a pretty good glide path for those just in terms of spending that's already been appropriated. I think there are areas on the tech space that are very good. I think there's areas in the healthcare sector that are also very good. So there are sectors that work fairly well, but it's kind of trying to figure out who's got the most risk in terms of margins right now, and that will move as you start to see things change because of the it'll start with raw materials and then it'll start to go up the food chain. Mm-hmm. But right now there are places where you're going to get squeezed, and I think that's going to be the tricky part going into the next 12 months.
Sarah, it's always so fun to get you on. Thank you so much, Sarah Hunt of Alpine Woods. Good to see you. All right, coming up, the other wild cards, what's happening over in D.C. Democrats really kicking the U.S. debt ceiling talks down the road along with Republicans for about 2 months. More on what this means for Biden's infrastructure agenda. That's next. This is Bloomberg.
This is Bloomberg Markets. I'm Ritika Gupta, and you're looking at a live shot of the principal room. Coming up, William Rogers, Institute for Economic Equity at the Federal Reserve Bank of St. Louis. That's at 1:30 p.m. in New York. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. For the second month in a row, the U.S. economy added fewer jobs than forecast. Payrolls rose by 194,000 in September. That's the smallest advance this year. The unemployment rate fell to 4.8%, partly reflecting a decline in the size of the labor force. All this could complicate a potential Fed decision by the Fed to start scaling back monetary support before the end of the year. The European Union is exploring joint action to ease the energy crisis. Bloomberg's learned that one of the proposals would have national governments jointly buying and storing natural gas to avoid future price shocks. Gas and power prices have soared to records in recent weeks because of limited supply. Democrats in Congress are starting to discuss how to make cuts in President Biden's sweeping social spending bill. The president had originally proposed a $3.5 trillion outline. Now he's willing to go down to $2 trillion. The key Democratic Senator Joe Manchin says he could support only $1.5 trillion. Senate Majority Leader Chuck Schumer is hoping a deal can be reached by the end of October. Amazon chairman Jeff Bezos says government policy must create incentives for all companies to change when it comes to energy. Bezos spoke to a B20 panel hosted by Bloomberg's Francine Lacroix.
We would urge governments to be more ambitious in their climate goals. All G20 members should commit to the 2030 targets, the so-called NDCs, consistent with reaching net zero by mid-century. Some G20 countries have yet to do this, many have.
Bezos also called on governments to commit to eradicate use of the internal combustion engine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. Guy, he also went on to say that we're going to have more jobs of higher quality during the energy transition, that consumers are going to have better products. I think the question becomes, how long does it take for us to get to those better, higher quality jobs? There obviously is going to be a huge skill gap as you transition into this green energy future. How do you do that? I mean, are we going to miss out on a generation? How quickly do we have to invest in those workers to transition? And are people actually doing that?
So this is the problem, isn't it? You've got basically a series of gaps in this energy transition that we still haven't figured out. We don't have all the technology we necessarily need. We don't have the skilled labour force that we necessarily need. And I think what we're seeing in Europe is just maybe the beginning of this process. It's going to be unbelievably bumpy. He's pointing at China as well, basically saying you've got to get on board. Which again is pretty interesting too. But this mismatch in terms of aspirations and reality, I don't think anybody's quite yet fully figured out the ramifications of all of that.
Yeah, and are we going to have, in the meantime, an environment where it's more inflationary with maybe less productivity until we can kind of flip that switch, which also then leads us to the infrastructure bills that are sitting in Congress right now. The progressives have been like, no green, no deal, and you really need that kind of investment to help spur the sector. I don't know how big we're going to get it. I don't know how big it's going to be.
No, I don't think anybody knows at this point. The numbers, if you actually take a step back and think about the range of money we're potentially spending, and I appreciate it's over a long period of time, but nevertheless, these are
huge numbers.
Trillions of dollars.
Yeah.
Trillions of dollars in terms of how much money is ultimately going to be spent by the government. So it's certainly something that's worth paying attention to. Janet Yellen was also the Treasury Secretary talking at that same event. And I thought what she had to say was interesting as well. She talks about the fact that the US is still, regardless of kind of, even if it's 1.5, the US is still spending a lot of money here. Other countries potentially, and the UK right here, could be definitely put front and centre here, potentially thinking about maybe withdrawing some of that stimulus. She's pretty keen for everybody to continue.
U.S. economic recovery is intertwined with the global economy. To this end, I've encouraged other major economies to continue strong support measures to sustain their recoveries.
Everybody needs to continue to work pretty hard to make sure the recovery is on track. The problem then is, what do you do with that, Alex? Because you find ourselves in a situation where you could argue that we are now in an inflationary environment. And does government need to continue? Should government continue to spend money in that environment at these kinds of at this kind of scale? I know there are plenty of people in the States that are worried about that. If we end up unleashing inflation, that's going to be incredibly damaging. Yeah, exactly. And that's sort of where we're in the logjam over in Congress. So let's get more on that with Emily Wilkins, a Bloomberg government congressional reporter. Emily, we still have Congress that needs to, walk and chew gum at the same time. All the different things are still on the table. They need a budget resolution. They also need the debt ceiling and then the two infrastructure bills. What's the state of play over the weekend?
So breaking it down, the first deadline that's coming up is October 31st, and that is when Speaker Nancy Pelosi has said that she wants to get to an agreement on President Biden's reconciliation, that social welfare and tax plan. And Democrats are currently working on that, but they still have a long way to go. Lots of questions of how much programs should be funded, whether they're going to try and look at a number of different issues or sort of focus maybe on a couple key areas and really try and get those right. That's around October 31st. Of course, they could potentially go past that date as well. After that, the next big date, circle it in red on your calendars, is December 3rd. That is not only the date that Congress is going to have to figure out how to lift the debt limit for potentially the long term, potentially the short term, but they're also going to have to figure out how to fund the government, because if it doesn't happen by that point, there will be a shutdown.
Let's just talk about that debt ceiling story, because there's increasingly this narrative that maybe the Democrats are going to try and get rid of it forever and try and ultimately kind of put this issue to bed. No other country really has these kinds of problems. Emily, if they were to try to do that, how would it work?
That's such a great question, because that is something that you will hear. You've heard it from Treasury Secretary Janet Yellen. You've heard it from House Democratic Majority Leader Steny Hoyer, who have said, we don't want to have to deal with this battle. It's something we don't want to do. There are a couple different options for how they could do it. Democrats have talked about ideas such as minting $1 trillion coin. They've discussed passing legislation that would require the Treasury Secretary to be the one to continue to raise the debt limit. So there's a potential proposal out there where they could raise the debt limit to, say, $100 million gazillion dollars, some number that we know they're never going to reach.
Well, I don't know. Possible.
Yeah.
How do they do it, Emily? Emily, how do they do it? What's the procedure?
And that's a really good question, because the thing is that it would be hard to get Republicans to go along with a lot of those ideas. I mean, Republicans have really been able to successfully leverage these debates over the debt ceiling to get their own priorities through as well. And so I think that's why at this point you're just talking about a simple raise of the debt limit. Remember, too, if Democrats do this through that reconciliation process, that means they don't need Republicans. They're limited in what they can actually do. The reconciliation process isn't for everything. It's only for things that have a direct impact on federal spending and how money is spent.
Emily, thanks a lot. Really appreciate it. Bloomberg's Emily Wilkins, great reporting this week. Thanks very much. This is Bloomberg. Every Friday when Guy and I are here, we both talk about our favorite chart of the week. So here's mine, Guy. It is not a commodity, so sit down. It's going to get exciting.
Wow, okay.
It's sort of commodities. But, okay, this looks at five-year swaps for the EU, US, and the UK. The yellow line is the UK, the blue line is the US, and the white is Europe. Because I've been really wondering what's been leading the jump in yields that have happened in the UK and why we haven't really seen the euro move that much. And I think that this chart really helps explain it. These inflation swaps are almost 4% in the UK. In the US, we're over 2. We're not even at 2. Over in Europe. And I think that this is where we're seeing the central bank divergence. And this is what's really leading the rate market and the FX market. And we can blame a lot of stuff this week, Guy, in the debt ceiling, et cetera. But I really think it's something like this chart that has led a lot of the market action that we've seen.
Yeah, and you look at what's happening in the UK, the gas crisis, what is happening more broadly in terms of labour shortages, Brexit, you roll that all in together, it's certainly producing a fairly negative picture for the UK right now. Potentially the Bank of England has to tighten into weakness, which is not something that many central banks really want to do. So this is my chart. I completely and utterly ripped this off from Kit Jukes' morning note this morning from SocGen. This is him. All him. It's a great chart. So what you've got here is the spread between the Citibank surprise indices between the UK, between Europe, the Eurozone, and the United States. And the Eurozone data has been going down. The surprise index has been falling. The US one's been going up. And the Euro has been tracking this really closely. Unless you get a significant move, Kit argues, above 116, the dollar's still in charge. European closes next. Hope you like the charts. This is Bloomberg.